Wow. If you were watching the ticker tape this morning,
Oh,
you probably felt your stomach just drop through the floor.
oh yeah.
It's Monday, February 9th, 2026, and we just saw one of the most, violent, fascinating whipsaws I have seen in a long time. We're talking about Cleveland Cliff ticker CLF.
It was absolute chaos. But, in the best possible way if you're a value investor.
I don't know if I call it the best possible way if you were holding calls at 9:30.
Yeah.
The stock opens and
Right.
it craters. It drops nearly 25%, hitting a low of around, what, 11.96?
Yeah.
For a huge industrial company. I mean, a pillar of American manufacturing.
Yeah.
It's terrifying. But then it claws its way back all day, inch by inch, to close near 1464.
It's the kind of day that separates the tourists from the locals, right? It's a masterclass in price versus value, a moment that would have Warren Buffett reaching for a cherry Coke and, his checkbook.
And that's the real question we have to answer today. Was that plunge this morning a sign of a dying industrial dinosaur finally giving up? Or was it the last chance to buy a coiled spring before a massive 2026 recovery? We've got a stack of earnings reports, filings, a whole Buffett-style analysis to figure it out.
Let's do it.
Before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it.
We have a mountain of context to get through here. This morning, Cliffs released what you'd call a kitchen sink quarter. The headlines were just ugly.
Right.
The net loss was wide, and
Right.
the algorithmic traders, they just panicked.
But that recovery, that suggests the human beings, the ones who actually read the footnotes, they saw something else entirely. They saw a turnaround story hiding in all the detail.
Exactly. Our job today is to parse that noise from the signal.
All right, let's organize this properly so we don't get lost in the weeds.
Yeah.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
Right. So to understand why the market had a complete panic attack this morning, we first have to understand what Cleveland Cliffs actually is. And, frankly, most people get this wrong.
How so? They think steel mill, right?
Well,
Rust Belt, smokestacks, and they just move on.
That's it. And that's like saying Apple just, makes phones. It's true, but it misses the entire ecosystem. The sources we looked at describe Cliffs as a vertically integrated fortress.
Oh, fortress.
Yeah, and to really appreciate that, you have to contrast it with the rest of the industry. So most of the modern steel guys in the U.S., companies like Nucor or Steel Dynamics, they operate what are called mini mills.
Okay, I know the term. These are the ones using electric arc furnaces, the EAFs.
Correct. EAFs are great. They take scrap metal shredded cars, old buildings, washing machines, and they zap it with a massive jolt of electricity to melt it down into new steel. It's a very flexible model.
You can turn it on and off.
You can turn the furnace on and off based on demand, exactly.
So it sounds more efficient. Why doesn't everybody just do that? It seems like a lot less work than, digging giant holes in the ground.
It is efficient until it isn't. The problem is the raw material. When you run a mini mill, you are completely 100% dependent on the price of scrap metal.
Okay.
You and every other mini mill are out there fighting over the same pile of old cars. So when the economy gets hot, scrap prices go to the moon and your margins just get crushed.
And Cleveland Cliffs doesn't have that problem.
No, because they are the guardian of the blast furnace route. This
Yeah.
is that mine-to-metal architecture.
Yeah.
They don't rely on the scrap market. They literally dig their own feedstock out of the ground.
This is the iron moat that the reports keep mentioning.
That's it, yes. They own these massive iron ore mines in Michigan and Minnesota. The Tilden and Mustang mines are the big ones. So while Nucor is out there bidding up the price of shredded F-150s, Cliffs is pulling iron out of the earth at a stable, very low cash cost.
So when inflation spikes and scrap prices go crazy, Cliffs is insulated because their main cost is it's fixed in the geology of Minnesota.
Precisely. It widens their cost advantage in these inflationary times. But there's another layer here. It's not just about cost. It's also about chemistry.
Chemistry?
Yeah, think about that pile of scrap metal. It's not just pure steel, right? It has copper wiring, tin plating, all sorts of what they call tramp elements.
Okay.
When you melt that all down, you can't easily get the copper out. It just stays in the steel.
And I'm guessing you don't want copper in your steel if you're trying to make a car door.
You really don't. Copy makes steel brittle when you try to form it. So if you try to stamp a complex shape like the fender of a new Ford or the hood of a Lexus using scrap-based steel with all those residuals, it'll crack. You just can't get the surface quality you need for high-end auto parts from standard scrap.
So the mini mills are kind of stuck making rebar and I-beams, while Cliffs gets the high-margin car parts because they're starting with pure virgin ore.
Generally, yeah. That is the keep of the fortress we talked about, the automotive franchise. Cliffs supplies nearly half, think about that, half of all the steel used in American cars. They own that exposed market, the skin of the car.
Okay, but they aren't just relying on old-school blast furnaces, are they? I saw a lot of chatter in the reports about HBI and a plant in Toledo.
Right, this is the bridge. This is the bridge between the old world and the new. They built this huge direct reduction plant in Toledo, Ohio, and it produces something called HBI hot briquette iron.
I've heard it called super scrap.
That's a great marketing term for it, yeah.
Huh?
HBI is basically pure iron that has had its oxygen stripped out using natural gas. It's incredibly high quality, much lower in carbon, and crucially, it has zero copper or tin.
So why does that matter so much? Is it just for their own furnaces?
It gives them options, huge optionality. They can feed this super scrap into their own blast furnaces to lower their carbon footprint and boost efficiency. Or, and this is the real strategic checkmate, they can sell it to the mini mills.
Wait, they sell it to their competitors?
They do, because even the mini mills need to dilute their dirty scrap with pure iron units to make the higher grades of steel. So Cliffs isn't just a competitor, they're a critical supplier to the rest of the industry. It connects the whole Great Lakes shipping route right into the heart of American manufacturing.
That is a very powerful position to be in. But let's go back to the product for a second. I saw a major reveal in the notes about aluminum that seemed to be the real catalyst for the stock's recovery today. It felt like a one more thing moment.
It really was. This is the blockbuster news from the call.
Okay, let's unpack this. For years, the story has been that automakers are switching to aluminum to save weight. Right? The Ford F-150 went all aluminum a decade ago. It really seems like steel was losing that war.
And they were losing ground. I mean, steel is heavier, but steel is also much, much cheaper. The big problem for the automakers was something called the retooling wall.
The retooling wall, what's that?
Okay, so imagine you're Ford or GM. You spent billions of dollars to outfit your factory with these giant presses designed specifically to stamp aluminum panels. Aluminum behaves very differently than steel. It flows differently in the die. It springs back differently. You can't just shove a piece of steel into an aluminum press.
You'd ruin the part or break the machine.
Exactly. You'd break the die. So even if they wanted to switch back to cheaper steel to save money, the cost of ripping out all those machines was just too high.
They were trapped by their own past investments.
They were completely trapped. Until today, Cliffs announced a huge technological breakthrough. They've engineered a new grade of steel that mimics the flow and formability of aluminum almost perfectly.
Wait, hold on. So they can use the stamping machines that are already on the factory floor.
Yes, that is the breakthrough. Cliffs can now go to an automaker and say, you don't need to spend a single dime on new equipment. Keep your aluminum presses. Just feed our new steel coil into them.
And the automaker instantly saves a ton of money on the material cost.
Massive savings. Steel is significantly cheaper than aluminum. It just removes all the friction from switching back. Especially now, with aluminum supply chains looking pretty fragile, Cliffs is offering a cheaper domestic drop-in solution.
That's a total game changer. It's like they just unlocked a door that had been welded shut for a decade.
It fundamentally changes the math for the entire next generation of vehicle platforms.
Speaking of the next generation, we have to talk about the EV elephant in the room. There's this story that just won't die, that electric vehicles use less steel. You know, the battery replaces the engine blocks, so Cliffs is doomed.
It's a really common misconception, but if you look at the actual data, the steel intensity of an EV is actually quite high. But the real story isn't the car's body, it's the motor.
Tell me about electrical steel. I keep seeing these acronyms flying around, NOES and GOES.
Right. So NOES is non-oriented electrical steel. This is what's used in the motor of the EV. The rotor and stator have to spin at incredibly high speeds, and you need a very specific magnetic property in the steel to make that efficient. Cliffs is one of the few U.S. producers who can make those high-efficiency grades.
But the bigger story, from what I'm reading, seems to be outside the car itself. It's the grid.
That's where GOES comes in, grain-oriented electrical steel. Think about the charging network we need to build. Think about the AI data centers that are popping up everywhere. They all need insane amounts of power.
Right.
And to move that power from the plant to the user, you need transformers.
And transformers are filled with this grain-oriented steel.
It is the absolute core of the transformer. Without it, you cannot step voltage up or down. You cannot have a modern electrical grid, period.
And who makes that in the United States?
Cleveland Cliffs?
Anyone else?
Nope. Nobody. They are the only domestic producer of grain-oriented electrical steel.
That sounds like a monopoly on a piece of critical infrastructure.
It is. So when you hear AI boom or EV infrastructure, you shouldn't just be thinking about NVIDIA or Tesla. You should be thinking about the company that makes the one thing that makes all that electricity possible. They are the bottleneck.
Wow. Okay, so we have the iron moat, the auto franchise, the aluminum breakthrough, and a monopoly on the grid. That's the business. Now, let's talk about the people running it. Chapter 2, management evaluation.
A business like this is only as good as the capital allocator who's running it. And in this case, we have a very distinct character at the helm, Lourenco Goncalves.
Distinct is a polite way to put it. I've listened to his earnings calls. The guy is a brawler. He yells at analysts who ask dumb questions. He is not your typical polished, PR-managed corporate CEO.
No, he's a street fighter. But you have to judge him by the scoreboard, right? He took a dying iron ore miner that was effectively bankrupt, and then he rolled up the entire American steel industry.
It was a pretty aggressive buying spree.
Aggressive is an understatement. He bought AK Steel for the auto exposure. Then he bought ArcelorMittal USA for the scale. He bought scrap processors like FPT. He's the one who built the fortress we just described.
What was the logic there? I mean, Wall Street usually loves asset-light businesses. He went completely asset-heavy.
His logic was that in a commodity business, you just get bled dry by frictional costs, paying middlemen at every single step of the chain. By owning the whole thing from the mine to the finished coil, he eliminated all those leaks. He controls his own destiny.
He's also made some interesting moves lately that seem counterintuitive. Let's talk about the POCO partnership. This was a strategic pivot I really didn't see coming.
It's a fascinating piece of 3D chess, really. So PONESCO is this South Korean steel giant. They have incredible technology, deep pockets, but they face all these trade barriers trying to get product into the U.S. market.
And Cliffs is the opposite. They have the trade protection, that gatekeeper status, but they need capital and tech upgrades for some of their older mills.
Exactly. So this joint venture allows POSCO to enter the U.S. market through Cliffs. Cliffs gets access to non-dilutive financing and world-class technology, all without losing its American-made status. It's a way to fund the future without loading up on more debt or issuing more shares.
So he's using a potential competitor's money to upgrade his own moat. That's pretty clever.
Very. And then you have the Canadian pivot, the acquisition of Stelco.
Why buy a Canadian steelmaker? Doesn't that sort of dilute the whole American-made story?
This is all about market discipline. Stelco is a major producer right across the border. In the past, when demand would drop, Stelco might have dumped cheap steel into the U.S. market just to keep their mills running, which would undercut Cliffs.
So Goncalves bought them to shut that down.
Essentially, yes. By owning Stelco, he controls that capacity. He can prevent dumping and enforce price discipline across the entire Great Lakes region. It's about protecting the pricing floor. If you own the guy who used to undercut you, well, then nobody undercuts you.
Let's talk about how he handles the shareholders' money. Capital allocation.
This is where the tension lies today, really. In 2024, Goncalves was super aggressive. He bought back 6% of the entire company. That is a huge chunk of equity to retire in just 1 year.
But then in 2025, he stopped.
He slammed on the brakes, went into full cash preservation mode.
Which makes sense, given the kitchen sink year we're about to discuss. But now, with the stock at $14, surely he's got to be itching to buy more.
The temptation must be immense. Management owns about 2.7% of the company, so they are very aligned. Goncalves knows the stock is cheap, but he has to balance that against the debt load. He said explicitly that while buybacks here would be highly accretive, he has to manage the balance sheet first. He's playing defense now so he can play offense later.
Which brings us perfectly to the numbers, because you can't have a recovery without surviving the downturn. And looking at this earnings report, survival was definitely the main theme. Chapter 3, financial health.
Okay, this is where we have to confront the ugly reality of today's report. The Q4 2025 earnings were, on the surface, a total disaster.
Let's just run the numbers so everyone understands the pain. Revenue fell to $18.6 billion. They posted a net loss of $1.4 billion. And adjusted EBITDA, it collapsed from $773 million the year before to just $37 million.
$37 million in EBITDA for a company with this much heavy machinery it's basically zero. It's a razor-thin margin.
So, looking at that, I have to play the skeptic. Why did the stock recover? Is this structural decay? Is the business just broken?
That's the billion-dollar question, right? The expert consensus, and what the market eventually figured out today, is that it was a clearing of the decks. There were three big one-time anchors that dragged 2025 down. And the most important one is what they called the toxic slab contract.
Okay, let's unpack this contract. We hear about bad contracts all the time, but how bad can one contract really be?
It was a legacy deal with ArcelorMittal. Cliffs was obligated to buy these slabs, their semi-finished steel blocks, from ArcelorMittal to feed their rolling mills. The problem was the pricing formula.
How so?
The cost Cliffs paid was pegged to a global index that stayed artificially high because of energy costs in Europe and production cuts elsewhere. But the price Cliffs could sell the finished steel for here in the U.S. had dropped.
So they were contractually forced to buy high and sell low.
On a massive scale. It was a complete arbitrage nightmare for them. They were just bleeding cash on every single ton they processed under that deal. But here's the good news. That contract expired in Q4 2025. It's gone.
It just ended.
Poof. Gone.
And what does that mean for 2026?
Management estimates that simply replacing those toxic volumes with their own internal production, or just better price contracts, will add $500 million to EBITDA in 2026.
Wait. Just that one contract expiring is a $500 million swing.
Yes.
Yeah.
That single factor alone generates more profit than the entire company made in all of 2025. It's an immediate mechanical uplift to the bottom line.
That explains a lot of the optimism today. What were the other two anchors?
The second was the auto production lull. We've had 3 years now of depressed vehicle volumes, supply chain shortages, chip shortages, high interest rates.
Right.
But cars don't last forever. The average age of a car on the road is at a record high right now.
So demand is a coiled spring.
Exactly. The moment interest rates tick down, that pent-up demand is going to release, and Cliffs is massively leveraged to that volume recovery.
And the third anchor?
Asset optimization. Basically the costs of shutting down bad assets and integrating Stelco. These are messy, expensive one-time charges, severance pay, idling costs, integration fees. They make the GAAP loss look terrible. That $1.4 billion loss includes a lot of this stuff, but they don't reflect the future earning power of the company.
So if we look ahead to the 2026 guidance, the actual turnaround, what are we seeing?
It's a trifecta. First, volume. Shipments are guided to rise to 16.5 to 17 million tons.
Yeah.
Second, cost. They expect unit costs to fall by $10 per ton, mainly due to better coal prices and efficiency gains. That's the big one. Realized prices are jumping by $60 a ton in Q1 2026 alone.
Okay, let's do the math on that. Cost down 10, price up 60. That's a $70 margin expansion per ton if they ship 17 million tons.
That is operating leverage. In a high fixed cost business like steel, a small increase in margin just drops straight to the bottom line. That's why the cash flow is expected to swing so violently to the upside. The kitchen sink is empty, the bad contract is dead, the prices are up.
And that explains exactly why the stock clawed its way back from 1196. The market eventually did the math.
It did. But, realizing the math and having the stomach to actually hold the stock are two very different things.
Absolutely. We're going to get into the market sentiment and the real risks in just a minute. But first, want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Part 2. Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4. Market sentiment.
We opened the show talking about the panic, but we really need to analyze who is panicking and, more importantly, who is buying.
The morning of February 9th today was a total gut check. The headline algorithm saw net loss $1.4 billion and revenue miss and just hit the sell button, no questions asked.
That's the initial reaction, right? The surface level panic. The stock drops 25%. Algos don't read nuanced guidance about expiring slab contracts. They just see red ink. But then the human analysts, the smart money, they start digesting the earnings call. They see the 2026 guidance. They hear about the end of the slab contract.
And they start buying the dip.
They realized that the cleaning of the decks was a necessary evil to set up the big recovery. By the closing bell, the stock was pretty much flat. That reversal tells you everything. It tells you the structural thesis is still intact for the big players. They used the panic to build their positions.
And a huge part of that thesis is the regulatory environment. We have to talk about the regulatory fortress. We mentioned tariffs briefly, but Section 232 is a huge deal here.
This is massive. Under Section 232, tariffs on most steel imports have been raised to 50%.
50. It was 25% before, wasn't it?
Correct. It's effectively a wall of 50%.
Let's do the math on that. What does that actually look like for a customer?
Okay, so say a ton of foreign steel from a subsidized mill in Asia, let's say, costs $600 on the global market. You add a 50% tariff. That's a $300 tax. Now that steel costs $900 before you even ship it to the customer.
So if Cleveland-Cliffs prices their domestic steel at $850,
they're still the cheaper option. They win the business. It just raises the pricing floor for the entire domestic industry and gives them immense pricing power. They don't have to compete with dumped steel anymore.
but there was always a loophole, wasn't there? Transshipment. I remember hearing about steel getting laundered through Mexico.
Yeah, this is the back door. Foreign steel, often Chinese or Vietnamese,
Yeah.
would get shipped to Mexico or Canada, get processed a tiny bit, maybe rolled or painted, and then it would cross into the U.S. duty-free under the USMCA trade agreement.
And they closed that.
They slammed it shut with the new melted and poured rule.
Melted and poured. Explain that.
It means that to be considered duty-free, the steel must actually be melted in North America. You can't just import a slab from Brazil, roll it in Mexico, and call it North American. The liquid steel has to be born here.
And since Cliffs melts its own iron in its own blast furnaces in the U.S.,
They are the ultimate winner. They're compliant by default. This forces competitors who rely on imported slabs to pay the tariff, while Cliffs pays nothing. It's a massive structural advantage.
that's a huge tailwind. And speaking of protection, let's look at their contracts. The spot market goes up and down, but they have fixed contracts too.
Right, we mentioned the auto contracts earlier. In 2025, in the middle of all that chaos, Cliffs quietly renegotiated their big fixed-price auto contracts.
And they locked in higher prices.
They did. They basically built in an inflation shield. They locked in higher base pricing to reflect the new reality of labor and energy costs.
So even if the spot market gets a little wobbly in 2026 or 2027, a huge chunk of their business is already protected.
Exactly. It insulates them from that volatility. It turns a commodity business into something that looks a little more like an annuity.
Chapter 5. Ownership structure.
So who actually owns this beast? It's important to know who you're in the foxhole with.
Well, looking at the registry, you've got the usual giants. Vanguard and BlackRock each own about 9.7%.
Yeah. Standard passive money. It's sticky. They aren't selling because of one bad quarter. They own the whole market, so they're in it for the long haul.
But then you have ArcelorMittal. They own about 7.7%.
That's the interesting one, the strategic stake. Remember, ArcelorMittal sold their USA assets to Cliffs. They took stock as part of the payment, so they're a partner, a global competitor, and a major shareholder all at the same time.
Does that worry you? I mean, could they just dump the stock?
It's a risk, but they haven't yet. They seem to see the value in the gatekeeper strategy Goncalves has built.
And the insiders.
Management owns about 2.7%. Now, that might sound small, but for a company of this size, it's significant skin in the game. Goncalves and his team are going to feel the pain of a stock drop just like any other shareholder.
So the implication here is that this isn't some meme stock that's dominated by retail traders on Reddit.
No, not at all. It has a heavy institutional floor. But because of the debt and the cyclical nature of the business, it has a high beta. It's volatile. It swings hard, as we saw today. But the core ownership base is relatively stable.
Which leads us perfectly into the dangers.
Yeah.
Because no investment is a sure thing. And I don't want us to sound like cheerleaders here.
Yeah.
Chapter 6, risk assessment.
Right. Charlie Munger always said, invert, always invert. We know the bull case. So what kills this company? What makes this stock go to zero?
The first thing that jumps off the page is the debt. It's the debt spiral scenario.
The net debt is around $7 billion. Their annual interest expense, just the cost of servicing that debt, is roughly $600 million a year.
That is a big bill to pay every single year before you make a single penny of profit.
It is. So the nightmare scenario is this. What if a big recession hits in 2026? What if the auto recovery just doesn't happen? What if EBITDA doesn't recover to $1.5 billion? What if it stays at 37 million?
They can't pay the interest.
Exactly. They'd start burning cash. If that happens for too long, they breach their debt covenants, credit gets cut off, and the equity holders could get completely wiped out. That is the existential risk. That is why the stock trades at such a low multiple.
But they have a cushion, don't they?
They do. They have about $3.3 billion in liquidity. That's cash in the bank plus available credit lines. So even in a total disaster scenario where they're burning cash, they have a 3 to 4 year runway to figure things out. They aren't going bankrupt tomorrow.
And the maturities. Are there any loan sharks knocking on the door next week?
No, they've been very smart about this. They successfully pushed the debt wall out to 2028, 2030, so they don't have any massive loans coming due immediately. That buys them time for the strategy to work.
Okay, what about technology? We talked about the blast furnaces being a fortress, but aren't they also, old technology?
That's the technological obsolescence risk. There is a real fear that hydrogen steelmaking or some new EAF tech will make blast furnaces obsolete faster than anyone expects. If that happens, Cliff's massive assets become stranded liabilities. They become giant rusty paperweights.
But the HBI plant helps there, right?
It's their defense. The HBI plant is green steel ready. It can be converted to run on hydrogen eventually, so it hedges that risk. But it is still a risk.
And the legacy liabilities.
And
Pensions.
standard industrial risk, yeah. They have defined benefit plans for thousands of retired workers. If healthcare costs spike or the stock market crashes, which hurts the pension fund, that obligation grows. It's a weight on the balance sheet that a tech company just doesn't have.
Finally, key man risk. We praised Goncalves earlier, but the whole strategy really relies heavily on his specific vision and, his aggression.
He is the architect. If you were to leave abruptly or have health issues, the fortress might lack a commander. The whole cohesive vision could fracture. The market pays a Goncalves premium, and it would disappear overnight.
Okay, so we've looked at the business, the management, the numbers, the sentiment, and all the risks. Now let's bring it all together. What is this thing actually worth? Chapter 7, conclusion.
All right, let's look at valuation using the owner earnings approach. We need to figure out what kind of cash this business can actually generate in 2026 if this turnaround works.
Okay, walk us through the math.
Let's be conservative. Let's assume the recovery happens, but it's not some crazy boom. We'll estimate 2026 EBITDA at $1.75 billion.
That includes the $500 million from the contract ending, plus the price hikes and some volume recovery. That seems achievable.
I think so. So you start with $1.75 billion. You subtract the interest, which is $600 million. Subtract taxes, let's say $100 million. And subtract CapEx, the money needed to maintain the plants, which is guided to about $700 million.
And what are we left with?
You're up with free cash flow of roughly $350 to $450 million.
And the company today is worth what?
The market cap is about $7.3 billion, so that gives you a free cash flow yield of roughly 5.5%.
5.5%. It's okay. I mean, you can get 4% in a savings account right now. It's not screaming cheap.
Not on the surface, no. But that's the modest recovery scenario. Here's the supercycle option. This is why you buy the stock.
The bull case.
If EBITDA hits $3 billion, which they have done in past boom times, then your free cash flow jumps to $1.6 billion.
And the yield on that?
22%.
Wow.
You are buying the stock today at a 5.5% yield on the recovery, with a free option on a boom cycle that pays you 22%.
That's the asymmetry.
Plus, you have a floor. The stock is trading right near its book value of $11 to $13 per share.
And book value is just the accounting number. The actual replacement cost of those mines and furnaces has to be.
It's likely double the market cap. You couldn't build this company from scratch for $7 billion, not even close. You are buying dollar bills for 50 cents, provided they don't burn them in the furnace.
So what's the final thesis here?
You're buying the gatekeeper of American steel. You are protected by a 50% tariff wall. You have a massive immediate catalyst in that $500 million EBITDA swing from the bad contract ending, and you have the auto recovery as a tailwind.
It's a classic Graham and Dodd value play. Asset-rich, temporarily distressed, and selling for less than its replacement value.
The verdict is pretty simple. If you can stomach the volatility, this is a buy.
Actionable thought.
Accumulate on weakness, like what we saw this morning. If it dips below $12, you back the truck up. And you watch the debt pay down in Q1 and Q2 of 2026 like a hawk. If the debt number starts falling, the equity is going to fly.
Before we go, I want to leave our listener with one final provocative thought. Something to chew on.
Let's go back to the grid.
The transformers.
We know AI data centers are about to double our energy demand. We know the grid is old and has to be rebuilt. And we know Cleveland-Cliffs is the only U.S. maker of the special electrical steel needed for every single one of those transformers.
So is Cleveland-Cliffs actually a hidden AI infrastructure play that the market hasn't priced in yet?
I think it just might be. Right now, it's priced like a dirty old steel mill.
Hmm.
But if the market starts viewing it as a critical technology enabler for the entire AI transition, well, then $14 is going to look very, very cheap.
That is a powerful thought to end on. Like and subscribe to Stock Analytics AI for more deep dives like this one.
And just a reminder that this research is AI-based and for informational purposes only. It is not financial advice. Please do your own due diligence.
Thanks for listening to The Deep Dive. See you next time.